Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. For the last couple of years, the sexy stocks have been tech, AI, quantum computing, crypto. Well, we've got new kids sitting at the popular table, and it's maybe looking a little bit more defensive, dare I say boring, but sometimes that's where you can find the most beautiful returns. We're talking about that with Rebecca Teltscher of Newhaven Asset Management, who looks exclusively at this defensive, dividend-paying sector. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and the guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is brought to you by BMO Investor Line. We often discuss various stock ideas and market trends on the show. If you're looking to explore those ideas further, BMO Investor Line is an excellent source. Their platform provides in-depth research, powerful tools, and commission-free trading on over 100 popular ETFs. Plus, you'll find the BMO Investment Learning Center with educational resources and videos empowering you to make informed decisions. Remember, always do your own research before investing. Learn how you can earn up to $3,500 cash back when you open a new account at bmo.com/online investing. Rebecca Teltscher, thank you so much for joining me.
Thanks for having me.
We have so much to discuss, but I think it's really important for viewers to understand your bent and how you look at the stock market because you have a really specific criteria.
Yeah, so two main criteria is we focus on, defensive characteristics. Critical infrastructure, right? So we don't want to make bets on, what the market's going to do on a quarter to quarter basis. We take a long-term approach and we try to focus on what do consumers, what do they need, not want? So we want critical infrastructure that is often irreplaceable. If you think about a telco or utility, no new entrant is going to come into Canada and build new communication towers. So that provides, a buffer and a safety net in terms of low entry to, barriers to entry. We also like, just given that the companies are often in later stages in their cycle, we like the return of capital in the form of a dividend. So the more you focus on upfront returns in the form of a dividend, the less you're actually relying on stock prices. And there's nothing more evident than what's happening today in the market. Our portfolio is up year to date where, the US markets are down. And when your only form of return is capital appreciation, when that stock prices are down consistently, that could be detrimental to your overall long-term strategy.
And I know you're long-term, but we also have to acknowledge sometimes that strategy doesn't work when investors are feeling risky and they're chasing meme stocks and, the hot new latest thing and willing to pay 100 times earnings for it. That is never your style.
Absolutely not. And I, define not working. It wasn't popular. Let's put it that way in 2023 and 2024, not the most popular approach, but actually I think our clients, appreciated it. We're upfront with them saying, I'm not going to buy NVIDIA at 100 times earnings because, that's just too risky. And they're okay giving up that potential high risk, high return profile for something that's a little bit more stable and consistent.
Well, I want to ask you this because I feel like your style of investing is moving to the popular table in light of tariffs. And whether or not, April 2nd comes and fine, it's not industry-specific tariffs. Maybe now it's more targeted tariffs. We're still talking about tariffs. And, the market might forget that for a day or two, but it is weighing, and you can look at all kinds of indicators to show that it is weighing. So where are investors going to go? It feels like the instinct is going to reward that defensive dividend-paying approach.
For one, tariff reason. So any kind of market uncertainty, there's this flow to safety. But also, I think more importantly is that we've seen signs even before tariff. So at the end of 2024, there was a sign that the economy was slowing down. Canada for sure. And also signs in the US. I mean, things were starting to slow down. Consumer spending was slowing down. Employment seems to have, gotten to a point where it's not questionable. Like I think it was in August last year in the US, there was a terrible jobs report that caused the markets to panic for a week. And then they went back into their, risk on. But I think what we're seeing is our strategy really does work, because those days that the market is panicking and everyone is, looking for a flight to safety, I mean, we're already there. And actually it's that peace of mind that our clients have, that to know that, even when the market is panicking and all the news headlines is saying that, NASDAQ tumbles and the Dow is down, I get these emails saying like, are we in trouble? Should we go to cash? No, our portfolio's up. It's fine, actually. So, the stocks that we own are stable. The dividends, they're not getting cut. No one's cutting their dividends.
In your portfolio.
In our portfolio, so income is still being produced quarter after quarter. And so it's, it's been a good place to be right now, just mentally and actually, where the stocks are performing well.
So when there's a slowdown in growth, there's a lot of different styles that emerge. Sometimes when there's a slowdown in growth, people are willing to pay up for tech stocks because that's where the growth is. This slowdown, everyone's using the word stagflation, where growth slows, but the central banks can't rush to the aid of slowing growth because inflation is rising, hence stagflation, stagnant growth and inflation. Do you believe that that's where we're headed?
Huge risk, huge problem. And the funny thing is, last week when the Fed announced that they weren't cutting rates, but the market was up, there was nothing good about what Powell said. I'm listening to this. I'm looking at the market. I'm like, okay, I'm waiting for the market to kind of take a turn. And it never did. But in my opinion, unless I missed something, he was basically saying, growth is uncertain because of tariffs. And he's saying that inflation is at a risk of going higher, again, because of these tariffs. And so there goes the central bank's ability to come to the rescue, as they've done every single time. And I've, said this to my partner, Ryan, that, I feel like the ability to have normal market cycles don't exist anymore because the central banks always come in to save them. So we saw that in 0809, with quantitative easing. We saw it in 2020 with the pandemic. I mean, you have the central bank that's, easing policy, and you also have fiscal stimulus as well. So you have, between the government and central banks, there's just, they're putting in so much capital into the market, and it saves the day, and it limits the ability to actually have a real market correction. Like the pandemic should have been a real recession, but what did we see in the markets? We saw down and right up, back up there. We also saw the same thing, I think, was it now 2 years ago when there was a regional banking crisis in the US. So again, the central banks do a creative way of saving the day. And so I kind of wonder now, do they have the ability to do that? If inflation's on the rise and growth is slowing down, how are they going to stimulate the economy? So, to me, that was a negative statement from Powell, but the markets have been doing well since then.
I thought it was so funny because I agree with you. If you looked at the pure numbers, they took down growth estimates and they increased inflation estimates. So again, speaks to stagflation. And then I thought it was kind of insane that most strategists were saying, oh, the markets were up because Powell said inflation is transitory from tariffs. I'm like, are we really going to fall for that again?
Right.
That inflation is transitory.
It's like, I feel like, when have I heard that? Not too long ago. And it proved to be not transitory. So,
okay. So what is a stagflation playbook? I was reading a report, I think it was from Bank of America, and they were talking about utilities, telecom, energy. Those are the three sectors where you can have a nice time if, in fact, we're in a stagflationary environment.
I mean, sure, we're in those sectors. Those are probably our largest. Utilities is our largest sector. Energy and energy infrastructure. So mostly the energy infrastructure space. So the pipelines, we do have some energy producers and nat gas producers and telcos. So these are so I can't necessarily speak to the trade with regards to stagflation because these are sectors that we like no matter where we are in the economic cycle. So sure, if it works, I mean, it's working. Our portfolio is doing really well, but I mean, I could tell you many reasons why we like those sectors outside of a stagflation environment.
How about, given the pullback we've seen in some of these tech stocks, Are they starting to look interesting to you? Out of the Mag 7, Google and Meta, they're cheaper than they've ever been, and their growth prospects in general seem intact, although there's maybe a lot more question marks around Google's.
So here's what I find interesting. Since the whole tariff talk has caused more market volatility, it's interesting because when Trump announced tariffs the first time in Canada, you would expect the Canadian market to tank. I mean, it's not good for Canada, it's not good for the U.S., but it's a lot worse for Canada up front, right? Loss of jobs, loss of companies' ability to produce revenue, and then it would be negative for the U.S. longer term, or like a little bit of a lag before it's bad for the U.S. because, again, higher prices, lack of consumer spending, an already strained consumer. So you would expect a bigger pullback in the Canadian market and less of a pullback in the U.S. right now. What did we see? We actually saw the opposite. We saw the NASDAQ is one of the worst markets year to date, and Canada's actually up. And why? Valuations. The NASDAQ continues to be pricing such high growth. And if we are going into a period of stagflation, recession, economic slowdown, are those growth numbers still valid? And I think that's what's being in question. In Canada, valuations were already pretty reasonable. So I think the TSX was trading at half of the valuation of the NASDAQ, or was it the S&P 500, which means the NASDAQ would be even more. I'm not really sure, but significant discrepancy between valuations, PE multiples for the TSX and the US market. So it's interesting to see when there's periods of uncertainty, the stocks that are getting hit are the ones that have the highest valuation. And so I still think that a lot of the Mag 7 stocks and a lot of the stocks on the NASDAQ, particularly technology stocks, are priced to perfection. So if you have a technology stock that's trading at 60 times earnings, so maybe now it's come off and it's trading at 50 times earnings. I mean, is that a value, is that a good multiple? I mean, I don't know. I can't tell you. I think if we are going into a recession, I still think that's too high. I think expectations probably need to come down even more. A lot of it is based on this AI, AI trade. And we have yet to see that kind of come into fruition where companies are generating a sizable revenue pickup from this AI, investment. So I think it's too soon to tell.
So that explains why the Canadian market has done better than the U.S. market to this point. The question is, does that continue?
Good question. So again, I think Canada's been out of favor for a long time. I think there was this flow into risky stocks, I hate to say it, but like sexy stocks, whether it was, crypto, whether it was AI, technology. I mean, I think there was this lack of investment into the Canadian market. I think that's shifting back for many reasons. One, I think we're seeing Canada is reasonably valued, as we talked about. We're also seeing, Canada as a country just has all the natural resources that we need, whether it's oil, energy, power producers, water. I mean, we have all the minerals that we need in abundance. So I think that that's a positive. And without getting political, I mean, there is, going to be a change now with the election announced. And my only hope is that whoever the next prime minister is going to be more business friendly. I think there was a lot of mistakes made in hindsight in the past 10 years with regards to, let's just say, energy policy and decisions. So the perfect example is about 10 years ago, TransCanada, now called TC Energy, they wanted to do an Energy East pipeline that would have brought oil from, Alberta through the East Coast, through Quebec, and out to the refineries in the East Coast. And from there, they would have been able to export it off the coast of Canada. That project never went through. There was a lot of regulatory delays, and it just, I think TC abandoned that project. But think now, if that project would have gone through, we would have limited our dependency on only being able to export our oil or natural gas to the United States, and we would have had more options available. So I think to myself, like, whoever the next prime minister is should be able to look at the current environment and make more business-friendly decisions.
Do you think that those kind of decisions would happen under Carney? And I'm only asking that because I think under Poilievre, we know the answer, and he's been very clear about that. I think the bigger question mark for energy investors has been, well, is Carney the same negative to the sector that Trudeau was, or is he a positive?
I'm trying very hard to not let my personal views get in the way of my answer. I think Carney, if he doesn't already, but he needs to understand that the dynamics are now different with Trump as the president in the United States and the threats that have been made to Canada with regards to tariffs. So it would be unwise to take the same approach that Trudeau did with regards to advancing or taking the same approach to, energy policy.
I'm going to push you on this a little bit because I know it's making you uncomfortable, but you have your personal view. We all have our personal view, but then you also have to manage money, and that can't get in the way. And there are some who have said, should I be selling my energy stocks if, the Liberals get in for a fourth time? Like, how do you think about that? Not with your personal hat on, but with your money manager perspective.
Again, that goes back to what I said at the very beginning. Our stock picking process really focuses on what do consumers need, not what they want. Energy is something that not just Canadians and not just America, the world needs. We need energy. We need cleaner energy. So, we're more bullish, let's just say, on natural gas and on oil, but still bullish on oil. Again, unless there is a real alternative to oil and natural gas, it's not going anywhere. And so, again, we look at it as this is a need, not a want. It's not a discretionary. I mean, obviously, demand for oil will fluctuate, but there's no replacement right now. I would argue that, the sustainability that, the Canadian companies have in place are far better than, let's just say, global standards. And so, if I'm looking at greenhouse gases on a global basis, Canada producing more energy is positive at reducing greenhouse gases on a global, because if we're taking Canadian oil or Canadian natural gas to replace, China's coal-fired gas plants, that's a positive for greenhouse gases. And so I think it's short-sighted to look at, greenhouse gases emissions on a per-country basis. We really need to be looking at it at a global basis. And if Canada has the ability to export these, fossil fuels that produce lower energy to countries that need it, that produce high emissions, then I think that's a net positive.
All right. I'll take you off the political hot seat now and put you back in your wheelhouse. Let's dip into the mailbag and talk stocks. Okay, our first question here is on Algonquin Power and Utilities. And the question is Algonquin hopeless? This one coming from Skippy991 on X. Thank you so much for your question. First, maybe let's talk, why is the stock such a basket case?
How much time do you have?
We've got time. It's a podcast. You can go on and on.
I don't think I want to with the stock. So let's try to keep this one short. So, like many Canadian investors, we owned it. We owned it at, $20 and watched it continuously slide. So there was a lot of mistakes that the company made, and some of it was just poor timing. I mean, they announced a large acquisition at really like a poor time. I think it was Kentucky Power, at really an unfortunate time when interest rates were going up, and the metrics of that acquisition didn't make as much sense as when they initially went after it. They abandoned that acquisition, but the market just continued to penalize them for it. But if you look at Algonquin 3 years ago versus Algonquin now, I mean, they're really doing everything they can. They're changing the entire company. So one, new management team, that's a positive. Two, they've sold their renewables. I mean, everything but their hydro. Their hydro is minimal, but they'll sell that too. So they're selling all the renewables. They're really going to be a pure play utility asset. And so they're going to be a distribution utility. So similar to an Emera and a Fortis, we like the space. We like distribution utilities. And considering the valuation that Algonquin's trading at, you cannot get cheaper distribution utilities anywhere else on the market. So, obviously, we've all been hurt, the past few years, and it may take some time for investor sentiment to improve, but I think they're doing everything they can to change that. It's a long-term game. They've also had 2 dividend cuts. They didn't cut it enough the first time, so it caused them to cut the second time. But again, we like distribution assets. They're the cheapest on the market. They have exposure to some, states in the U.S. That they're seeing higher growth, and they have small. So what we like about utilities is we like when, because they're rate regulated by the jurisdiction that they operate in. And so if you compare it to, let's just say, a Hydro One, almost all their eggs are in the Ontario basket. So if they're filing a new rate, like a regulation for a rate reset for with the regulator, all of their earnings are going to be dependent on that one regulator, which is Ontario. Algonquin has many different small jurisdictions, many different states and provinces in Canada. So I think right now they have 20 rate cases that are currently waiting to be filed, and they're asking for higher rates. So, as they start to get settled, they should see incremental earnings, from the different filings that they have going on.
So Algonquin has underperformed, whereas Fortis and Emera have just taken off. They're doing incredible. So you have an opportunity to kind of buy the laggard of the group. And there's also an activist investor, like a well-known U.S. Fund, Starboard. The guy's name is Jeffrey Smith, who I think they just got a board seat, right? So they're really in there. How do you think about activism in these sort of situations? And does that give you confidence?
Yeah, I try not to focus too much on it. I do think it's a positive. I do think they do support the pure play utility that they're trying to do. So I do think that's a positive, with regards to actually year to date, Algonquin has outperformed Fortis and Emera. Obviously on a long-term basis, it's no question. You can't really compare them. Like Fortis is really like your tried and true, like you buy that stock, you own it forever. It's also trading a lot more expensive than Algonquin, but you're paying a premium for a premium management team and a premium assets. Algonquin, very cheap in terms of a valuation perspective. Negative investor sentiment right now for investors that have been burned, over the past few years. But can that turn around? We have the patience, so we're holding on to it for now. Let's hope that continues. Year to date, it's up, I think, 13% versus like Emera, Fortis are around 9%. So, they're all doing really well. And again, if we continue to see this trade about this move to defensiveness, again, Algonquin is going to get that pickup. And because they're, more of a small cap, torquier name, they should actually get a higher pickup than, your safer Fortis and Emera.
Okay, let's talk telcos. The second question is about Telus. What are Rebecca's thoughts on Telus as a long-term hold? This one coming from Corey on X.
Yeah, so the first thing I look at when I see Telus, 8% yield. Sign me up. They're not cutting that dividend, unlike other telcos that we may talk about later. But 8% yield, if you look at them compared to other telcos, they're probably in the best financial position. So, they've all made a lot of, Rogers, they've made a lot of investments with regards to their media assets. But, with regards to Telus and Bell, they've been doing a lot of investments, the fiber to the home. Telus is further ahead than the other telcos with regards to their capex. So like they're over that hump. They're, maybe a year or two ahead of BCE. So in terms of their financial position, that's going to continue to improve. And again, I look at the infrastructure, the infrastructure assets that they own, whether it's through the real estates, the towers. They have a lot of financial flexibility should they want to monetize, like what some of the telcos in the U.S. have done by selling some of their towers to, an American tower corporate, like a real estate company. So they have a lot of flexibility. They probably have more growth than the other telcos ahead of them. And if I'm getting paid an 8% yield to hold on to this stock. And again, the telcos have very defensive characteristics. And in its simplicity, if we're going into a recession, are people going to stop paying for their cell phones? Probably not.
So They're underperforming. They've all as a group pulled back for a long time. But I want to just talk in the short term because even though people like the defensive characteristics and maybe are flocking to them in other parts of the market, I wonder if our Canadian telcos are not benefiting from that because of concerns around immigration and competition that is acting as sort of an extra weight on the sector. They did really well because there were all these new Canadians that were coming to the country, and one of the first things they do is get a cell phone with one of the providers. How do you think about how immigration weighs on their growth potential?
Yeah. So with regards to immigration, sure, those targets are probably coming lower, but I think Canada is still seeing the highest immigration or highest population growth out of the G7 countries. So still positive, just maybe not as positive. So it makes sense that the stocks have, the valuations have come off, but they're still growing. And we're not buying the telcos for, high growth. We're buying it for stability and slow and steady growth. And we're okay with that. Like that's, setting, we set those expectations. Like I'm not expecting Telus to double, but I'm expecting it to have consistent, steady, long-term growth.
Okay, now let's bring up that other telecom that might cut its dividend. This question is on BCE. Everyone seems to think that BCE is going to cut the dividend. Do you think it's inevitable? And what will it mean for the stock? And I think that's an important question. This one coming from Steve in Ontario. And just the very latest on the dividend yield on BCE, it's 12%. And that's high for a company like this.
If you asked me a year ago if I thought Bell was going to cut its dividend, I would have said absolutely not. If you're asking me today, I think, yeah, maybe, probably. So first, I think a lot of retail investors buy BCE for the yield. Do they want the dividend cut? No. Institutional investors don't necessarily need or want the dividend. They don't need the yield to live off of the way retail investors would. So I think there might be a push for institutional investors to want management to cut the dividend. And I do think because there's a large weighting of institutional investors that own BCE, I think the stock would go up if they do cut. I don't think, I'm hoping if they do a cut, maybe they'll just cut it by half. And so, a 6% dividend yield on a company that owns critical infrastructure is not terrible. But I do think that the probability of a cut is probably greater than 50%.
So I actually read a note by Scotia that was talking about what you're saying, like what happens when they cut. And it's interesting you say that the stock is going to go up. And one of the things they said this hinges on, like when you look back historically, is if you're going to cut, do it right the first time and don't be forced to cut again. So contrast that with, like you were just saying, Algonquin. They didn't cut enough. They had to cut again. Is that going to matter here as well? Like, do they need to be really, really sharp here?
Absolutely. Obviously, cutting the dividend once is not a good sign, but you definitely don't want to have to do it more than once. I think one of the main problems with BCE has been the lack of transparency to investors. And so if I can use the example last year, when they made the announcement that they were divesting the MLSE assets, the stock went much higher because investors were like, great, now they're going to be able to pay off debt. And so that's what investors wanted. Not too long later, they invested the acquisition of Ziply. That's where the stock tumbled, and that's where we saw the 10+% dividend yield. And I think if they were more transparent with regards to their use of the funds, of what they were going to do, maybe it would have gone better. But I think investors were caught off guard by that acquisition because now that came into question. They're like, well, no, they're not paying down their debt. They're actually going to be buying something. And so they weren't happy about it. If we knew what they were doing from day one, I could have rationalized it and said, you know what? They're selling an asset that has gone up in valuation to purchase an asset that is undervalued, that is accretive to EBITDA on day one. So, okay, that makes a little bit more sense, but that's not what management did. So I think if they are going to cut a dividend, I think transparency to the investors as to what they're going to be doing with the funds and what their strategy for capital deployment is going forward is key.
So I wonder if in addition to the dividend cut, it comes with an announcement of management change.
That I'm not sure. I can't speak to that, but whoever is making the announcement, I think they just need to be clear about their path forward.
Our next question is about Nutrien. What is a catalyst for Nutrien? How does the current state of Russia-Ukrainian conflict affect dynamics? This one coming from Andrew. And I guess you need a little bit of backstory to know that when that conflict began, it created a shortage in potash, which drove prices up, which benefited Nutrien, and now that has come off.
Yeah, so, I mean, I believe there are rumors that Russia and Belarus are going to start or are going to, start not fixing prices, but being in a better relationship right now than they have been in the past. And so that could be negative for potash prices. Nutrien's done really well this year, but I'm not sure if it's done well because of the Russia-Ukraine conflict or if it's just because it's come off so hard last year. When I think about Nutrien as a stock, I like to think that, yes, like potash prices impact the stock, but when we invest in it, which is probably not the norm for most investors in a stock like Nutrien, but we focus it. Half of their business is actually a retail business. So like they're a retail agriculture business. That revenue from the retail business is what pays their dividend. So that side of it is safe. We look at it as any upside from potash prices is a bonus. So that's how we view it. And again, I feel like a broken record, but we focus on needs, not wants. If I think about needs, I mean, fertilizer, agriculture, these are all very long-term needs.
All right, let's take a quick break and we'll get into more of your questions. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Okay, let's go through some of our next questions. One is on Gibson Energy. Would you buy at these levels?
It's not. So, we have a large position in energy infrastructure. We are very positive on the space. I mean, we've kind of discussed, how energy is a need, not a want, and how, there's really no alternative to the energy that's being supplied and transported. I mean, right now there's no one building a new pipeline, cross border. So the ones that exist right now are just more valuable than ever. Gibson is not one of the ones that we own. We have other pipelines and energy infrastructure names that we prefer. Gibson has historically, and I think they're working and they're getting better at it, but they had a higher marketing segment. So that's like their commodity price business. So they had a higher exposure to commodity prices than some of the other pipeline companies. They also have a higher weighting to oil versus natural gas, and we're more bullish on natural gas on a go-forward basis. So for those reasons, we don't own Gibson. They did have their earnings a few weeks ago. They were terrible earnings again from the marketing side. So you see, like that could fluctuate. So in a quarter where commodity prices are better, they can have, they could blow it out of the water, right? So, but again, when it comes to the stable part of our portfolio, like we want that consistency in earnings. So, we would own Pembina Pipelines over Gibson. Also, that Pembina has better growth prospects than Gibson right now. I don't think it's a bad company, but understand that it's a little bit riskier than more traditional pipelines that have a higher percentage of the revenues that are contracted or fee for service.
I'm sitting on a big gain on Manulife and wondering if I should keep holding or sell. Is there much more upside? This one coming from Sharon in Milton.
Yeah, good question. I mean, we've owned that for a long time. For many years, the stock kind of did nothing. And now we're starting to see it take off. So, I mean, I think like for us, it's doubled since we initially owned it. So if we're not selling it broad based in terms of we're not making a call to trim the entire position. For clients, let's just say, that need cash for something, like that's probably one of the first names that I'm going to, just because the position has become a larger weighting in our portfolio. Can it go further from here? Yeah, definitely can. I mean, it's a nice diversifier from the traditional banks. I think if we are going into a recessionary period, it may, they may outperform the banks just, because of the nature that it generates revenue through the insurance side.
It sounds like you're saying, though, the best gains maybe are a little bit behind it for now.
Possibly. Again, the way I look at it is like it's done really well after doing nothing for many years. So on an average basis, I mean, the earnings are, the 5-year CAGR on that is looking nice. But yeah, we have seen outsized gains. Do I expect it to continue? Not at the same pace that it had, but I think it could still go higher from here.
The compound annual growth rate. Okay, let's get to our final question here. This one is about an ETF. What does Rebecca think about the Hamilton U.S. Bond Yield Maximizer ETF, ticker HBND? It uses covered calls on U.S. bonds and yields over 11%. This one coming from Peter in Toronto. So it's kind of a yield on a yield, which sounds incredible. Doesn't everybody want that?
I'm going to try to answer this question the nicest way I can, and I'm not sure if I can do this very nicely. Okay. I would say you're paying 0.5% to lose money. That would be the nicest way I can say it. I mean, okay, so let's break it down. It pays an 11% dividend yield. Inside the actual, and this isn't just for the high, this one specifically, the underlying our U.S. Treasuries and covered calls. They have, if you go on their website, they have dozens of different what they call yield maximizers that all pay yield over 10%. The underlying stocks that they own or bonds that they own do not generate 12% yield. Even they could call it all they want, covered call, they're selling call options, and they're not, absolutely not generating 12% yield. So how are they paying that 12% yield? Eating at their NAV, so their net asset value. Think of that as like a stock price. So they are paying an investor 12%. So the investor is collecting 12%, but what's happening is their NAV or their share price is consistently going down. So if you look at a stock price of any of their funds, you'll see it consistently go down. Now, here's the interesting thing. When I went on Hamilton's website and I looked at all of their yield maximizer funds, none of them had a history of more than a year and a half. Over time, you would expect, again, you're paying 12% yield. You're not generating 12% yield to pay that out. So it's eating at your capital. So that stock price goes down and down. Why am I not seeing that? Well, they don't have a history, so that they are most likely either consolidating different funds as they kind of go down. They consolidate the funds, they rebrand it, they call it something else. And then that way it's to me disingenuous. I mean, I'm going to say on a worst case, it's disingenuous. On a best case, they're just, rebranding. But at the end of the day, it's not transparent with regards to what's happening to that, to that capital. Eventually, I mean, on a long-term basis, that capital it'll take a long time, should get to zero, as if they're just paying out more than what they're generating. So, if it sounds too good to be true, it is. So if you are buying healthcare ETF that's paying out, a 6% dividend yield, you have to look at what are healthcare stocks in general paying. Look at the top 10 holdings. If the top 10 holding is J&J and J&J pays a 2% yield, there's no way they're paying 6% dividend yield distribution.
So where can you go for an 11% yield, or is that just like that's a little too hopeful to find in the market?
Right. It's too hopeful to find in the market. I mean, BCE, but brace for the cut. So, there's a sweet spot for dividend yield. So, again, we focus on dividend yield. Last year, the yield on our portfolio was 5.1%. Now it's about 4.5%. Again, stock prices have gone higher. Expect lower yields. Again, you have to look at what long rates are doing as well. And they've come down since last year. So, again, if it sounds too good to be true, it is. So, we have some of our dividend yields, like, again, we talked about Telus, some of the pipes pay 6%, but that's, that's pretty much, the most you could do in a market like this. That Hamilton fund, their return since inception, total return since inception was 1%. It's been negative for a while, but since inception, and again, that inception is only a year and a half, 1%. So you're paying 0.5% in fees, but the stock's really done, the ETF's done nothing for you.
Okay, good perspective. Well, let's get into maybe more plain vanilla holdings and get into your pro picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, your first Pro Picks here is Premium Brands Holdings. They own a bunch of different food chains?
Yeah. So what I like about them is actually they have about 60 different brands and banners, none of which stand out in terms of what you would know. When I started looking at the company, I didn't really, know much about this. And then it was only once I started going to the grocery store, Costco, and I would buy certain items. I'm like, oh, that's a Premium Brands product. Cooked, ready-to-made cooked chicken packets. I buy them from Costco in a 10-pack. And, it's so easy because it's cooked chicken. I just make a salad. I put my chicken in the salad. That's a Premium Brands product.
The only one I recognize is Yorkshire Valley Farms because they make the organic chicken nuggets that I feed my kids. But you're right, the other brands I don't super recognize.
Exactly. I buy Pillars, sausage for my kids in their lunch, or the little pepperoni sticks, things like that. So they have two main business segments. So one of them is again the products that go into the stores, the food, specialty foods, and then the other one is the food distribution. So think about they distribute to, let's just say, restaurants, but not just restaurants. Think about school cafeterias, hospitals, things like that. So distribution is again it's probably it's more wholesale, so lower margins, a little bit of commodity exposure, and then the specialty foods is the retail side of it.
So the stock is down over the past year, and I've heard some analysts or seen some analysts talk about tariff exposure. Help me explain why is the stock down, why is now the right opportunity to get in, and what is the tariff risk?
Yeah, tariff risk is actually very small. I think it got penalized. So if we back up a little bit, before the tariff exposure, the stock was down significantly prior to tariffs. And that was just from, again, I met with management. They probably one of the most disciplined management teams we don't usually like, discretionary food space, but, you talk to this management team and they are just so disciplined with regards to their capital. So they were a merger through acquisition. They did a lot of acquisitions historically. The pandemic came, a lot of these, staple names went up, and valuations became not as attractive. They became very high. So there was a period of time where management just did not do a lot of acquisitions. Market just wants consistent, they always just want growth. And management told us, we're not growing for the sake of top line growth. If we're going to do an acquisition, it just has to make sense on a bottom line. So they held off for a while. They were, returning capital through higher dividend increases and dividend growth, which we're happy with. And the stock started to look interesting because I think a lot of investors just, kind of gave up on them. And that's where we kind of look in. We're like, 4.5% yield, growing dividend, stable business. Valuations are now very attractive. So we got in, and then there was the tariff. So, but the tariff exposure is actually very minimal. So they were a Canadian company. Most of their assets are still in Canada, but recently they've done a lot of growth in the United States. So they're doing a big capital spend to build up a distribution facility in the United States. And the way they explained it is one of their largest customers, for example, is a Costco. Canada is a much smaller market than the US. So right now they have a lot of, products that go national in Canada, and they're able to do that through their distribution channels in Canada. the Costco US has been asking them to put some of their products on the shelf, and they just don't have the capacity because, I mean, once you're going national with a product in the US, I mean, it is several $1 million, with regards to a product. And so they knew that they were going to have to expand their capacity build out in the US. So they've been working on that for the past few years. I think they've invested close to $700 million on building out a US expansion. And we're used to that, just through owning the pipelines and things like that. Like, we're used to, you invest the capital first and then, the revenues come later. I think in the food distribution, it's not as popular of this wait and see, and because obviously as you're deploying capital, it's impacting, your EBITDA, your margins are lower. We're patient investors. So we see this, they're almost done this expansion. They've actually announced 3 in December, 1 in their earnings last week of U.S. Small, U.S. acquisitions. So they have now capacity to do these build outs in the United States. And we're just kind of waiting for that to come to fruition. And again, because of the management team that is so disciplined, we have full faith in them. So that's, one of the things with regards to actual like the entire consumer space has been hit with tariffs, but actually their cross-border sales is less, I would say about 3 to 5%, very little. Those acquisitions that they've done in the US helps mitigate it even more because any cross-border they can now move to the United States. So it'll be tariff agnostic. So the stock has come off, I think, more than it needs to. And I think this is a great entry point.
So yeah, I did see one analyst say it's about 500, 600 million out of 8 billion in projected revenue. So it's very small, and you're getting paid that 4% dividend yield to wait. Let's move on to your second one, which is AltaGas. This one's sitting at around a 10-year high. So premium bands is like a bit more of a buy the dip story. Not so with AltaGas. So explain the play here and why you think there's more upside.
Great. Yeah. So I usually hate choosing a stock. I like to give myself a buffer, right? If I'm wrong. And we're all-time highs at this point. So I'm like taking a little bit of a risk, but that's how convicted I am with AltaGas. And so I think AltaGas was kind of ignored by the market historically because of their business mix. So it's half utilities, half midstream, or like energy infrastructure. So like, gas processing, pipelines, things like that. And I think the thinking around it was, well, if you're an investor that wanted a utility exposure, you would just buy a pure play utility like a Fortis. If you wanted midstream exposure, just buy Gibson or Pembina or Enbridge. So you don't need both. But right now, I actually think this is a great mix to own both. I mean, utilities are doing really well, that defensive play, the flight to safety. And I think midstream is also doing really well with regards to, AltaGas specifically has very niche growth projects right now that, again, given the whole tariff uncertainty, they have several LPG projects, and one of their largest build out right now is
what's an LPG project?
Liquefied propane. So they are exporting propane to external markets in Asia. And so they have one at Ferndale off of the coast of Washington State. They also have one on Ridley Island. And now they just announced, I believe it was in December 2024, that they reached FID. So they made a final investment decision. They're currently building out Reef. So Ridley Export. I wrote it down. Ridley Island Export Terminal. Okay. And so again, they're increasing the ability to and we're talking about this a lot. We don't want to be as reliant on the United States. So now there's an ability for propane to be exported off the coast of Canada, the west coast of Canada, into Asian markets. If I'm a gas producer in Canada, with exporting my gas to the United States is a little bit uncertain with regards to tariffs. Are there going to be tariffs? Is it going to be 10%? Is it going to be more? I may want to look to solidify a contract through AltaGas's, terminal, and to have a little bit more diversification with regards to the end client. And so they are seeing a huge uptake in terms of commitments to capacity. So not only do they have the capacity to do the initial build out, but they could actually expand it even larger than what their initial plans are. So again, given the mix of utilities and midstream. I think it's a great mix. I also just want to add this one little point that I find hilarious. For their utilities business, so the majority of their utilities is actually in the US. So Virginia, Maryland, Washington, D.C. I also wonder if Donald Trump is aware that the White House is currently being powered by a Canadian-owned company. So, I mean, I kind of get a little pleasure in knowing that it's AltaGas being, Canadian stock is powering the White House right now.
That is a good little nugget. Good for our viewers to know as well. And maybe if Trump listens to the podcast, he's going to find out. Okay, let's get to your third pick. This one is on Canadian natural resources. It's been a bit of a dog. It has lagged the broader energy sector in Canada. It's rebounded in the month of March, but it's also lagged oil prices. What is it? Because everyone seems to love Canadian natural resources, and yet the stock is under pressure.
Yeah, I've had a dog. Like that's really harsh. Like that hurts. I mean, I would say CNQ is probably the most enticing buy in the market right now. I mean, it's underperforming its peers due to, it doesn't have, let's just say, U.S. exposure the way some Canadian energy companies do. It doesn't have refining the way like a Suncor does. But I mean, it is undeniably the best managed Canadian energy company ever. But I wouldn't even say the best management team, not just in the energy space, but in the world. I mean, they are the most disciplined management team. I mean, they don't have a CEO, like they have like an investment team. And they just, I mean, similar to our investment strategy, like they just take a long-term view. They don't speculate on oil prices. They don't, they don't take risks. They've done accretive acquisitions at rock bottom prices. I mean, they did like 3 large acquisitions in 2020. I mean, those were incredible acquisitions. They just did a big acquisition of Chevron's Canadian assets at the end of 2024. They have a strong commitment of paying back capital, whether it's through buybacks, dividend increases. They just have a strong commitment to capital back to those shareholders.
I'll water down my dog comments because it's underperformed recently, but yes, taking that long-term approach, CNQ's up 700% compared to the energy sector, which is only up about 240%. So like it's massively outperformed over the long term.
I am not done talking this thing up. I mean, so I was just talking about the capital to the shareholders, but even if you look at their assets, the highest quality assets, lowest decline rates, I mean, they're still making money, when oil prices were $40. I mean, the environment now, I mean, oil prices have come off, but, with the exchange rate, like these guys are still making money. They're like the decline on their, on their assets are lower than any other, U.S. energy company. I mean, historically, you were paying a premium to own premium assets. Now you are getting premium assets for a steal, in my opinion. Also, like CNQ to have a 5.5% dividend yield. I mean, this is a screaming buy. I also want to say, like, people think of CNQ because it's one of the largest Canadian oil producers. They think of it as an oil company. It is not. It's 60 oil, 40 gas. They have huge exposure to gas as well. I think they're the second largest gas producer in Canada. So, you're getting a good asset mix, quality assets, best management team, strong dividend yield that's continuing to increase. There's nothing to not love about CNQ at these prices.
So is there a catalyst? Does something have to go right for everybody to wake up to this prospect?
So first, investor sentiment. If we are heading into a recession, I mean, oil prices are going to go down. So could there be weakness with regards to the entire sector? Sure. I mean, CNQ is already down, 10% in like this year. So will it go down even further? I mean, hard to say. That it can play into mix, tariffs. I mean, again, it got hit because of tariffs being down, but the tariff of 10%, I mean, the impact on FX already mitigates that 10% tariff. So I don't really think that's an issue, but I mean, I'm scratching my head as to how this thing is trading as low as it is. But, on a short-term or long-term basis, I mean, I think it's a great, if you don't own it, own it. And if you, own it, like buy more or average in or to me, this is one of the best names that you can own forever.
No waffling there. I love the high conviction. Thank you so much.
Thank you so much for having me.
Thank you so much to Rebecca Teltscher of Newhaven Asset Management for joining us. Don't miss next episode. We've got Jordan Zinberg on the show. He's at Bedford Park Capital. We know that small caps have had a very rough start to 2025, and Jordan traffics exclusively in small and mid caps. Where is he finding safety? Where is he finding opportunity? And if you've got questions, please send us a question to questions@inthemoneypod.com, or you can submit them anywhere on social media. We are everywhere at In the Money Pod, and we'll see you on the next episode.